Senior Equities Strategist at ING Investment Management. He's been working in the markets more than 20 years now. He's currently responsible for the firm's investment recommendations. Patrick Moonen is his name, joins us live now from The Hague. Patrick, good to see you. Thanks for being on the show. So you're positive on equities despite some of the volatility that we've seen in the markets. Why is that?
Well, there are a number of reasons why we are positive for equities. First of all, well, we do expect that earnings will grow double-digit this year, both in Europe as in the United States. Secondly, if you look at valuations, well, they are, if you look from a historic point of view, they are in the lower end of their historic range, but also relative to other asset classes like fixed income, equities are quite attractively valued. A third point is that, well, corporates are finally spending their money by buying back their own equities, by increasing their dividends, and by doing takeovers. Then finally, well, if you look at liquidity flows, well, they are back flowing into equities, both developed as well as emerging markets.
Okay, so from what you're saying, this is going to be fueled by takeovers, M&A, earnings growth that we've seen. But what about the risks and challenges to your outlook? And I'm thinking specifically the sovereign debt crisis here in Europe and ECB policy tightening.
Well, it's clear that there are some headwinds building. I think the most important ones are, well, the situation in the Middle East and then the sovereign situation in Europe and monetary tightening. But generally what we do see when these things happen is that the pace of the equity market rise slows down. But it's more importantly is what we see is internal rotation out of the more cyclical sectors and companies towards more defensive sectors and companies.
I actually wanted to ask you about a Bloomberg investor poll, get your thoughts on this, because 85% of the people that we surveyed said that Greece probably will default and that Portugal and Ireland could suffer the same fate as well. I mean, the view in the markets right now seems to be that, you know, for these countries, they're not solvent, their debt to GDP ratio is too high. This situation is not sustainable.
Yeah, true. We also think that sooner or later Greece will have to restructure, but we doubt that we will see that restructuring already this year. So it will be postponed, according to us.
And I just wanted to get your thoughts on where commodity prices are headed. We're getting a lot of debate about this right now. You know, many oil experts saying, you know, actually the fundamentals haven't changed. We could see oil go up to $120, $130 by the end of the year. And then we had comments just there from Jim O'Neill saying that, listen, we're making too much of China inflation. What are your thoughts on these things?
Well, we generally think that commodity prices are still well supported by emerging market demand. For example, for the oil price, we do have a trading range between $110 and $130. Currently, we are at the lower end of that trading range, so we are still constructive with regards to the oil price, and we think that the oil price from here will rise again.
So does that mean that inflation could become a problem?
Well, not in the short term. I think the main driver of inflation are the output gaps. Output gaps are still quite important in developed markets, as for once. And secondly, we also do not see any increase in wages. So those are two important elements that, according to our view, will keep inflation in check. And thirdly, well, central banks are gradually starting to tighten monetary policy.
Okay, well, you know, wonderful to get your thoughts. Thank you so much, Patrick Moonen, Senior Equity Strategist, ING Investment Management. Thanks very much.